What do affluent retirees need to know about this new tax law? Today, we're breaking down the biggest tax law change in nearly a decade, the One Big Beautiful Bill Act, I can't make it up, and what it means for retirees. No politics, no opinion, just plain English answers to save you from slogging through 870 pages of legal jargon. This bill was signed into law on July 4th and keeps many familiar tax rules in place, but also throws in some surprising twists that retirees need to know, both good and not so good. Here are the 5 biggest changes for retirees and what they mean for your money. Number 1, the standard deduction and the new Senior Bonus Deduction. All right, good news first. The lower tax brackets and bigger standard deduction we've all enjoyed are now permanent. And even better in 2025, married couples filing jointly, the standard deduction is now $31,500, up from $30,000. Single filers get a standard deduction of $15,750. If you're over 65, you get the extra $1,600 per spouse, or $3,200 if you're both over 65. But here's the real headliner. The brand new Senior Bonus Deduction, an extra $6,000 per person or $12,000 per couple if you're 65 or older. That means a married couple over 65 can deduct nearly $47,000 in 2025 if they take the standard deduction. But not so fast. This bonus starts to phase out at $75,000 if you file single and $150,000 if you file a joint return. It disappears entirely if you're above $175,000 and $250,000 of income. So precise tax planning just got even more important. Number 2, this is a disappointing one. Social Security benefits are still taxable. Unfortunately, the bill did not eliminate taxes on Social Security as many had hoped. The same old formula, unchanged for 40 years now, still applies, meaning anywhere from 0 to 85% of your Social Security benefit will be taxable, depending on your income. Number 3, state and local tax deductions get a boost. If you live in a high tax state, this one really applies to you. The state and local tax, or SALT deduction, is the total amount of state and local income taxes and property taxes paid. Right now, you can only deduct $10,000, but it's been changed to $40,000 starting in 2025, but only if your income is under $500,000. Above that, it phases back down. This higher SALT cap is temporary and only applies to tax years 2025 through 2029. Before it reverts back to $10,000. Number 4, estate tax limit rises. So prior to the bill, the estate or death tax exemption was set to revert back to $5 million per spouse, adjusted for inflation in 2026. A pretty big change. This bill changed the federal estate tax limit to $15 million per person, is now made permanent, or $30 million per couple, starting in 2026. So that's a pretty big relief for families worried about passing wealth to their heirs without getting hit with federal death taxes. Number 5, charitable giving gets even trickier. So starting next year, there's 2 changes to charitable planning. If you itemize your deductions, there's a new floor. You can only deduct charitable contributions above 0.5% of your income. So if your income is $200,000, for example, the first $1,000 of charitable donations you make will not count for a deduction at all. If you do not itemize your deductions and take the standard deduction, there will be a new above-the-line charitable deduction of $1,000 for individuals and $2,000 for married couples. So what's the bottom line? This bill creates new opportunities like the senior bonus and estate tax relief, but also adds more complexity with phase-outs, floors, and temporary provisions. If you're not sure how these changes affect you or what moves you should make before year-end, reach out and let us run the numbers for your specific tax situation. It's not what we make that counts. It's only what we get to keep after taxes that matters in the end.